Have you ever felt the pressure to invest your money but didn't know where to start? Do you find yourself wondering if you're making the right choice with your hard-earned money? Investing can be intimidating, but it doesn't have to be. In today's video, I'm going to show you the top 5 things to check before making any investment to ensure that you're not just throwing money into risky ventures. By the end of this video, you'll be equipped with the knowledge to make smart, informed investment decisions that align with your financial goals. Let's get started. 1. Define your financial goal and time horizon. The first thing you need to do before making any investment is to define your financial goal and understand the time horizon you're working with. Without this, it's easy to make hasty decisions that might not align with your bigger objectives. So, what's the reason you're investing? Are you saving for a short-term goal, like buying a car or taking a trip? Or are you looking to secure your financial future for the long run, maybe by saving for retirement? If you're aiming for a short-term goal, like less than 3 years, you want to keep your money safe and focus on capital preservation. In this case, you might want to consider low-risk options like high-yield savings accounts or short-term treasury ETFs. These options allow you to earn some interest while keeping your money protected. For goals with a medium-term horizon, let's say 3 to 10 years, you can start thinking about bonds and large-cap equities. These are slightly higher risk, but offer a balance between growth and stability. Now, if you're aiming for long-term financial growth, such as saving for retirement over the next 10+ years, you have the luxury of being more aggressive in your investment choices. This is the time to dive into diversified stock portfolios or explore alternative assets. The beauty of long-term investing is that you have time on your side to weather the ups and downs of the market, which helps you recover from volatility. By defining your financial goal and understanding when you'll need the money, you'll make much better investment choices that are tailored to your unique needs. 2. Assess your risk tolerance and staying power. Once you've defined your financial goals and time horizon, the next critical thing to assess is your risk tolerance. How much risk are you comfortable with? Risk tolerance refers to your ability to handle market fluctuations and the emotional strain that comes with them. It's one thing to hear about market dips, but it's another thing entirely to experience them personally in your portfolio. If you're someone who finds it difficult to sleep at night when your investments lose value, you might need to reconsider the level of risk in your portfolio. A simple exercise you can use to assess this is the sleep test. Ask yourself how you would react if your portfolio dropped by 30%. If this thought causes you to panic or consider selling your investments, you might be too exposed to risk. In 2026, experts predict that the market will be more focused on structure rather than high-risk, high-reward investments. A good way to approach this is by using a barbell strategy, which means combining high-growth investments, like AI stocks, with safe, defensive assets such as investment-grade bonds. This allows you to enjoy potential growth while protecting yourself from sharp market dips. Understanding your risk tolerance is essential because it ensures that you build a portfolio that you can live with, one that allows you to handle market downturns without making emotional decisions. By having a clear understanding of what you're willing to risk, you'll be better prepared for whatever the market throws your way. 3. Ensure you have a solid financial foundation. Before jumping into the world of investing, it's essential to make sure you have a solid financial foundation in place. You should never invest money that you may need for urgent expenses or emergencies. Investing is about building long-term wealth, not covering immediate costs like medical bills, car repairs, or unexpected expenses. If you don't have a solid financial cushion, you may be forced to sell investments at a loss to cover short-term financial needs, which defeats the purpose of investing altogether. The first step in building a solid foundation is to create an emergency fund. This is your safety net. Experts recommend setting aside enough to cover 3 to 6 months of living expenses in a liquid, safe account. This way, you won't have to dip into your investments if something unexpected happens, like losing your job or dealing with an emergency. Having this fund in place gives you peace of mind and ensures you're financially secure, regardless of any curveballs life may throw at you. Along with your emergency fund, another crucial step is to pay off high-interest debt. High-interest debts, like credit cards or payday loans, can quickly spiral out of control. Paying off 20% plus interest rates on credit cards gives you a guaranteed return that's usually far greater than what you'd earn from investments. Once you've freed yourself from high-interest debt, you'll be in a much better position to invest, knowing you've taken care of your financial obligations. By ensuring your foundation is strong, you create the stability needed to invest with confidence and peace of mind. 4. Analyze the investment's fundamentals and costs. Now that you have your foundation and risk tolerance figured out, it's time to dive into the investment's fundamentals and costs. One of the most dangerous traps in investing is chasing after the latest hyped-up investment or following trends without doing your own research. Never invest in something you can't explain or understand. Start by understanding the revenue model of the company or asset you're considering. What is their growth potential? How do they make money? And what about their profit margins? These fundamental questions will give you a clear picture of whether the investment is likely to succeed or if it's just a speculative gamble. Next, consider the fees. A lot of people overlook this, but fees can eat into your profits over time. For example, high management fees in mutual funds or ETFs can significantly reduce your returns. Look for low-cost index funds or ETFs that provide broad market exposure with minimal fees. A small fee can quietly erode your earnings by thousands of dollars over time, so make sure you're aware of what you're paying. Also, valuation matters. Many stocks in 2026 are trading at high valuations. Experts recommend looking for value beneath the surface, especially in sectors or international markets that are undervalued. By choosing undervalued assets, you increase your chances of purchasing investments that will outperform over time. 5. Verify liquidity and exit strategy. The final critical factor to consider before making any investment is liquidity, essentially how easily you can turn your investment into cash without a significant loss in value. Understanding liquidity is essential because it directly impacts your ability to access your money when needed. For example, stocks and ETFs are highly liquid since they can be sold quickly in the market without much delay or loss of value. On the other hand, investments like real estate or private credit may tie up your money for several years, making it harder to access funds in case of an emergency or unexpected need. In addition to liquidity, you must have a clear exit strategy for each investment. This means determining when and why you'll sell your investment. Are you planning to sell when the asset hits a specific target price, or will you wait for a market condition or indicator to trigger the sale? A well-defined exit strategy gives you a plan of action so that you're not making impulsive decisions during a market downturn or due to temporary emotional reactions. Instead, you'll know exactly when it's the right time to sell. A sound exit strategy also ensures that you can liquidate your investments at the most opportune time to maximize your returns. Whether you're investing in stocks, real estate, or any other asset, a clear exit strategy helps you stay on track to meet your financial goals without deviating from your plan. This foresight will allow you to take advantage of favorable market conditions and avoid unnecessary losses. And there you have it, the top 5 things to check before making any investment. By defining your financial goals, assessing your risk tolerance, securing your foundation, analyzing the investment's fundamentals, and planning your exit strategy, you'll be much more prepared to make smart, informed investment decisions. If you found this video helpful, don't forget to like, share, and subscribe. Hit the notification bell to stay updated with all the latest tips on how to manage and grow your wealth. By following these steps, you'll be well on your way to making investments that not only protect your money, but also help you build wealth for the future. See you in the next video.